Hey everyone, and welcome back to the channel. Today, we're rediving into something that sounds complicated, but is actually the secret language of finance, ratios and percentages. I promise. By the end of this video, you'll see that these aren't just boring math terms. They are powerful tools that turn confusing numbers into clear, actionable insights. Whether you're looking at your own budget, thinking about investing, or just curious about how businesses work, this is for you. So, why are ratios and percentages so important? Imagine you have two companies. Company A made $1 million in profit and company B made $500,000. At first glance, company A looks like the winner, right? But what if I told you company A had to spend $10 million to make that profit, while company B only spent $1 million? Suddenly, the picture changes completely. This is where percentages come in to save the day. They help us understand efficiency and profitability in a way that raw numbers just can't. They give us context. Let's start with one of the most common concepts you'll hear about, the profit margin. It sounds fancy, but it's super simple. The profit margin is just a percentage that tells you how much profit a company makes for every dollar of revenue. Let's say you run a small coffee shop. You sell a latte for $5. The coffee beans, milk, cup, and a bit of the barista's time cost you $3 in total. Your profit is the $5 you sold it for minus the $3 it cost you, which is $2. Now, to find the profit margin, you take that $2 profit and divide it by the selling price of $5. 2 divided by 5 is 0.4. To turn that into a percentage, you just multiply by 100. So your profit margin is 40%. This means for every dollar you earn from selling coffee, 40 cents is pure profit. This single number is incredibly powerful. If your margin is high, you're running an efficient business. If it's low, it might be time to look at your costs or maybe even raise your prices. Another related idea is the markup. People often confuse markup with profit margin, but they're different. Markup tells you how much you've increased the price from what it costs you. Using our coffee shop example again, the cost was $3 and you marked it up by $2 to get to the $5 selling price. The markup percentage is that $2 increase divided by the $3 cost. That gives you about 0.67 or a 67% markup. So you marked up the price of your ingredients by 67%. Both margin and markup are useful, but they tell slightly different stories about your pricing strategy and your profitability. Now, let's move on to ratios. If percentages help us understand parts of a whole, ratios help us compare to different things. They are the ultimate tool for comparison. One of the most fundamental ratios in finance is the DTU equity ratio. Again, sounds complex, but the name tells you exactly what it is. It compares a company's total debt to the total amount of money invested by its owners, which is the equity. Imagine a company has $100,000 in debt from loans, and its owners have invested $50,000 of their own money. The debt to equity ratio is 100,000 divided by 50,000, which equals 2. A ratio of 2 means the company has $2 of debt for every $1 of equity. Is that good or bad? Well, it depends. A high debt to equity ratio could mean the company is taking on a lot of risk. If business slows down, those debt payments could become a huge problem. On the other hand, a very low ratio might mean the company is taking advantage of opportunities to grow using borrowed money. There's no single magic number. It's all about balance and comparing it to other companies in the same industry. Let's look at another super practical ratio. The current ratio. This one helps us understand a company's short-term financial health. It compares a company's current assets, things like cash and inventory, that can be turned into cash within a year, to its current liabilities, which are debts that need to be paid within a year. Let's say a business has $50,000 in current assets and $25,000 in current liabilities. Its current ratio is 50,000 divided by 25,000, which is 2. This means it has $2 of assets for every $1 of debt it needs to pay soon. A current ratio above 1 is generally seen as a good sign. It suggests the company has enough liquid resources to cover its short-term obligations. If the ratio is less than 1, it could be a red flag. It might mean the company could struggle to pay its bills on time, which is a stressful situation for any business owner. By tracking this ratio, a company can see problems coming and make adjustments before it's too late. Now, how does this apply to you in your everyday life? You can use these same principles for your personal finances. Let's create a personal D2 asset ratio. Add up all your debt, student loans, credit card balances, car loans, then add up all your assets, stay cash in your savings account, the value of your car, any investments you have. Divide your total debt by your total asset. This gives you a snapshot of your financial leverage. Is the number high? Maybe it's time to focus on paying down some of that debt. Is it low? Great. You're in a strong financial position. You can also calculate a personal savings rate, which is a percentage. Take the amount you save each month and divide it by your monthly take-home pay. So if you earn $3,000 a month after taxes and you manage to save $300, your savings rate is 10%. Experts often recommend saving between 10 to 20% of your income. Knowing your rate tells you exactly where you stand and helps you set realistic goals to improve. Are you saving enough for retirement, for a down payment on a house? This simple percentage gives you the answer. Let's go back to business for a moment and talk about comparing companies. This is where ratios really shine. Let's say you want to invest in a retail company. You're looking at two big clothing stores, Store X and Store Y. Store X has a profit margin of 10%, and Store Y has a margin of 5%. Right away, that Store X is more efficient at turning sales into profit. But you don't stop there. You look at their debt to equity ratio. Store X has a ratio of 3, while Store Y has a ratio of 0.5. This tells you that while Store X is more profitable, it's also using a lot more debt, which makes it a riskier investment. Store Y is more conservative. Neither one is definitively better. It depends on your personal risk tolerance as an investor. Do you prefer higher potential returns with higher risk or steady, safer growth? Ratios don't give you the final answer, but they give you the right questions to ask. They frame the decision for you. Let's do a quick step-by-step recap of how to use these tools. First, identify what you want to measure. Is it profitability? Look at profit margins. Is it short-term financial health? Check the current ratio. Is it risk? Analyze the debt-to-equity ratio. Second, find the numbers you need. For a public company, this information is in their financial statements, which are available online. For your personal finances, you'll need your bank statements, loan documents, and budget. Third, do the simple math. Divide one number by the other. Remember, for a percentage, you'll usually multiply the result by 100. Fourth, and this is the most important step, interpret the result. A number on its own is meaningless. You have to compare it to something too. The company's past performance to its competitors, or to industry averages. For your personal finances, compare it to your own goals or to general financial guidelines. Understanding ratios and percentages is like learning to read a map. Before, the financial world might have looked like a confusing jumble of roads. Now, you can see the landscape clearly. You can see where you are, where you want to go, and the best path to get there. It builds confidence. You're no longer just guessing or relying on someone else's opinion. You can look at the numbers yourself and make an informed decision. You are in control. So, my challenge for you today is this. Pick one. Calculate your personal savings rate this month, or if you're interested in investing, pick a company you like and find its profit margin or debt-to-equity ratio. Don't worry about being an expert overnight. The goal is to start getting comfortable with these concepts. It's about turning numbers into insights. And those insights are what will drive smarter financial decisions for the rest of your life. And that's a wrap. I hope this has demystified ratios and percentages for you. They truly are the heartbeat of finance, simplifying everything from profit to performance. If you found this video helpful, please give it a thumbs up and hit that subscribe button. Let me know in the comments which ratio you're going to calculate first. Thanks so much for watching, and I'll see you in the next video.